For the fifth question, which is P7-32, consolidation worksheet in the year of intercompany transfer. So Prime Company holds 80% of Lane Company stock acquired at January 1st, 2002 for 160,000. On the acquisition date, the fair value of NCI was 40,000. Lane reported earnings of 50,000 and had 100,000 of common stock outstanding. Prime uses the fully adjusted equity method in accounting for its investment in Lane. So we have the trial balance of both company on December 31st, 2006. And then we have additional information. At the date of combination, the book value and fair value of all separately identifiable assets and liabilities of Lane were the same. At December 31st, 2006, the management of Prime reviewed the amount attributed to goodwill as a result of its purchase of Lane stock and concluded an impairment loss of 18,000 should be recognized in 2006 and shared proportionately between controlling and non-controlling shareholders. Then the second one is on January 1st, 2005, Lane sold a land that had cost 8,000 to Prime for 18,000. So upstream sale of land. On January 1st, 2006, Prime sold Lane equipment that it had purchased for 75,000 on January 1st, 2001. The equipment has a total economic life of 15 years and was sold to Lane for 70,000. Both companies use straight line depreciation, so downstream sale of equipment. And then there was 7,000 of intercompany receivables and payables on December 31st, 2006, so this must be eliminated. Okay. A, we are asked to do all elimination entries to prepare the consolidation worksheet. And then B, we are asked to do the worksheet. C, we are asked to prepare the consolidated financial statements, okay, for 2006. So we need to start it from the goodwill. Okay, so just purchase price plus the fair value of the NCI. Okay, so purchase price is 160 and then the fair value is 40. Okay, minus the book value, which is 150. So we have the goodwill of 50,000. Why there is no excess of net identifiable assets? Because there is no because at the day of combination, the book values and fair values were the same. So all of the excess or the differential are given to goodwill. Okay, and then we go to the gain of the sale of land. Okay, so the gain will be 10,000. Okay, the gain will be 10,000, which I believe that had been eliminated on the first year. Okay, so the second year will be later. We will put the second year elimination entry. Okay, and then we go to equipment. Okay, so the equipment has been sold at January 1st, 2006. Meanwhile, it has been bought at January 1st, 2001, so 5 years. Okay, because 2001, X2, X3, X4, that's 5. Okay, so 5 years. So when Prime bought it at 75,000, divide by 15 years, it will become 5,000 per year for the depreciation. And then the accumulated depreciation at the date of sale will be 25,000, which is from 5 years times 5,000 per year. The book value will be 75,000 minus 25,000 or 50,000. So when Prime sold it to Lane, it is 70,000. Then we will have a gain of 20,000. And then when Lane want to record the depreciation, it is 70,000 divided by the rest of 10 years. So the depreciation is 7,000 per year. And then the difference of the depreciation would be 2,000. Yeah, before we do the elimination entry, then we need to do first the T account so that we will have the correct number later when you put it in elimination entry. So for the buildings and equipment, Prime bought it at 75, Lane bought it at 70. So we need an additional of 5,000 to change it into 75,000. And then we eliminate the gain first because this is the first year of the sales of or transfer of the equipment. Okay, so the gain is 20,000 on credit. We need to eliminate it by putting 20,000 in debit, so it's 0 already. And then the depreciation expense, originally recorded by Prime is 5,000, but recorded by Lane is 7,000. So we need to change it to 5,000 by crediting 2,000. And then for accumulated depreciation, okay, so when at the date of sale is January 1st, okay, so we need to add another 5,000 to the accumulated depreciation of 25,000 at the date of sale. So from the consolidated viewpoint is 30,000 for the accumulated depreciation. Meanwhile, for Lane, because this is the first year, so the accumulated depreciation is only 7,000, exactly the same with the depreciation expense recorded. Okay, then remember to put this 2,000 from the eliminating of extra depreciation. So we need to add 25,000 to change it into 30,000. Then we can go to the basic elimination entry. So basically, again, you just move the data from the trial balance, okay, debit common stock, debit retained earnings, debit income from Lane. So you just take the sale to calculate the net income from Lane. You just take the sales minus the COGS, depreciation and amortization and other expenses. So it is 50,000. Okay, so if you want to distribute to Prime, it is 80%. Remember to minus the gain, okay, on the sale of the equipment, and then we plus the extra depreciation or the realized depreciation, sorry, the realized gain on the sale of the equipment. Okay, because this is downstream, okay, so it is only contributed or allocated to the parent's account, in this case the Prime's account. For debit, NCI and NI is simply 20% of 50,000 of Lane's net income, and then credit dividends declared. Then credit investment is 80% of the common stock plus retained earnings, plus 80% of Lane's net income minus 80% of Lane's dividend, and then minus the gain, okay, and then plus the extra depreciation, okay, and then for the credit NCI in NA of Lane, okay, 20% of the common stock plus retained earnings, plus 20% of Lane's net income minus 20% of Lane's dividend, okay. And then because we have the goodwill, remember, and then that there is a goodwill impairment loss, so we have this amortized differential reclassification entry. Debit goodwill impairment loss 18,000, allocate to the parent 80% 14,400, to NCI 20% 3,600. Okay, so we have the differential reclassification entry, okay, so the goodwill now only 32,000, okay, because it has been impaired. And then we allocate to the parents 80% or 25,600, to NCI 20% 6,400, okay. And then we have to record elimination entry for the land, okay, because this is upstream, so it is allocated to the parent and NCI, okay. 80% of 10,000 8,000, then 20% of 10,000 is 2,000, okay. This is the second year entry already, yeah, because the first year we eliminate the gain first, okay, the gain on sale of land. And then we need to eliminate the extra depreciation of 2,000, so debit accumulated depreciation, credit depreciation expense. Then this is the first year of the intercompany transfer of equipment, so debit gain on sale of equipment to eliminate the gain, then debit buildings and equipment, which is from the T account, and then credit accumulated depreciation also from the T account. And then remember we have intercompany receivable and payables. So we need to eliminate it by debit accounts payable, credit cash and accounts receivable, 7,000. Then we can go to the worksheet. Okay, just move the numbers from the trial balance from sales to COGS, depreciation and amortization, other expenses and goodwill, impairment, loss, remember, and we have gain on sale of equipment also. Okay, then income from lane. So the gain on sale is 20,000 from what we have calculated here. Okay, so just add it, sum it from the above to the bottom, then 87,600 for the controlling interest in net income. Also the same with lane company. So the net income is 50,000 that we have calculated when we do the elimination entry. Then we just move the elimination entries. Okay, income from lane, NCI, okay, and then goodwill impairment loss, income and NCI also, and then depreciation expense, and then that's all. Okay, so remember for this, because we want to minus the amount of depreciation and amortization, you should plus it. Okay, and then the gain, remember we must make it 0, and then the goodwill impairment loss you need to put minus because it's a loss. Then income from them must be 0, and then NCI, remember, minus the debit plus the credit. Yeah, and then after that, if it's the same already, you can go to the statement of retained earnings, just move the numbers from trial balance. Okay, and then the income is from the previous section, then the dividends also from the trial balance, and then you just move from the elimination entry. Okay, and then you will get 379,600 for the ending balance of the retained earnings. Then you can move to balance sheet. Okay, just move from the asset, cash and accounts receivable, inventory, land, building, equipment, investment, and then accumulated depreciation, and then we have goodwill also. Okay, so for the liabilities, it's only accounts payable, bonds payable, stock order security, common stock, retained earnings, and NCI and A. Okay, so just move the number, and please make sure it is balanced first before you put the elimination entry. So retained earnings, again, it is from previous section. Okay, and then you just move the rest of the elimination entry, which is common stock, and then investment, NCI and A, and then goodwill, investment, NCI and A also, and then this one also for the land elimination entry, this accumulated depreciation, and then this restate of buildings and equipment, and then the intercompany receivables and payables. Okay, so if you have moved all of it, please make sure to sum your debit credit column if it is equal or not. After that, you can go to the consolidated column. Okay, just plus minus like the way you do usually. Investment must be 0, remember, put the goodwill. Okay, so this is, you need to sum it and then you minus the debit. Okay, because payables increase in credit, so minus in debit, and then the rest is like the way we do usually. So the consolidated balance will be 1,055,000, and then C, you just make the consolidated financial statement like the way you do usually. Income statement, you just move off the numbers from the worksheet. Consolidated statement of retained earnings also. Okay, and then consolidated balance sheet also. Okay, just move all of it and take the consolidated column amount. And that is for the 5th question.